Hello, G Money Junkies. I'm here to help you invest in your future. Now, today I'm going to answer a question that I got in my mailbag, and it's about how someone can invest their money without the risk of losing it and making some money while he does it. So, let's go ahead and get started. So that's the panacea, right? Everyone wants to know how they can make money without risking any money. And I'm going to basically tell you that that is not possible. There's always a risk to anything you do. So here's a question that I got last week. Hello, G Money. I have a question for you. My son has about $4,000 saved up for college. He probably won't need all of it to start off. Should he invest $2,000 in bonds so that when he gets out of college, he can get the benefit of a higher interest rate? So this is a good question because one, it's a father looking out for his son, which is good. And two, they don't want to lose their hard-earned money that they had basically saved up for college. And that would be a very bad thing. So it's good to earn some money on it, but not to take too much risk so that you lose your college money, because college is the better investment. So technically, there's no such thing as no risk. There's always risk in life. Now, you have to understand, to get more reward, you need to take more risk. And that just makes more sense. Now, if something was risk less, then everybody would pile into it and then the rewards would decline. So just based on the pure supply and demand, anything that offers a higher reward for less risk, everyone will pile into, and then that reward will come down. So think about this. Keeping your money in cash is risky in and of itself because inflation is eating away at your money. So if you decide, I don't want to lose anything at all, well, yes, you are. The money supply in the country is increasing year by year, and if you save your money for next year, you've basically lost the purchasing power. And we went over that in the last show. So if you want to go back and see that, you can go ahead and see that. So everything is about opportunity cost. What are your other options? You can choose one thing, but you have to always think about, what else can I do? And when you think like that, just across life, then you will do better in life because you're always considering something new, and you'll always find new opportunities. So let's think about this. Let's say you decide right now you want to take your money and you want to earn 1.5% to 2%, and you want to do that for the next 5 years. Well, interest rates are set to rise 3 more times this year. That's an estimate. So if interest rates go up to 3% by the end of this year, but you've locked your money at 2% for the next 5 years, you've basically lost out on that extra percent for the next 4 years, because you've collected the 2% this year, but the next 4 years you could have collected more. So I would not lock in a lower interest rate right now just to earn a little bit of extra money, because you could earn more if you just wait. So fixed rate instruments such as bonds or CDs, and we'll get to that in a second, will pay more in the near future. So let's let the bank borrow from you. They will actually pay money to borrow money from you. Really? Well, yeah, they're actually already doing it, right? So if you have a bank account, you're already doing this. If you have a savings account, they're maybe paying you 0.5%. If you got a checking account, they're maybe paying you 0.1%. So you're already letting the bank borrow money from you, and they're basically lending out a certain percentage of that to other people. And so they pay you a small interest rate because at any time you can withdraw your money. So it's very, very low risk for you, but the risk you are taking on is getting paid less in interest and not keeping up with inflation. So that's the risk you're taking there. But if you decide that you want to let the bank borrow your money for a little longer, then they will actually pay you more interest, and the more money that you let them borrow, they will pay you even a higher interest rate because of that. And what these are called are CDs, or certificates of deposit. So what they do is they say, okay, well, if I borrow from the people who are giving me this money, this is the bank talking, at 2%, but I can lend out at 2.2, 2.3% for an auto loan, then the bank comes out ahead by 0.2, 0.3%. And that's how they make their money. They make their money by borrowing from you at 2% and then lending out at 2.3%. But they don't want to take the risk of you just pulling out your money and then these auto loans are out there and then they'll be out of capital. So that's why they offer these CDs or certificates of deposit. So basically, they lend money for mortgages or auto loans, but they need that money and they want to get that money from you. So you commit your money for a certain period of time and they will pay you a higher interest rate. And we'll look at that here in a second. So the longer you commit, the more interest they pay. All right, so what happens is at the end of the period, you get your entire deposit back. So if you basically put in $1,000, you will get your $1,000 back plus the 2% interest every year. So 2% interest would be about $20 a year, and you get that over 5 years. So you get $100. So you get $1,100 back in your pocket. But your $1,000 can only buy $900 worth of stuff because it's lost out to inflation. And you also got the additional $100. So basically, at the end, you've basically just kept up with inflation. What you could buy right now for $1,000, you will be able to buy 5 years from now for $1,100. So you've basically gained nothing, but you've kept up with inflation. Now here's the problem. If you withdraw early, you'll pay a penalty. So these CDs are basically a promise from you to the bank that, look, you will let them borrow your money for this amount of time, and they will pay you a certain interest rate and you'll get your entire money back. But if you need your money, which before you go into a CD, you basically do not want to put in money that you'll need within that period of time. If you need your money back, they will give you less because you're paying a penalty, and that would only make sense. So what's the opportunity cost? Well, let's say a 5-year CD was paying 2%. So if you invested $2,000, and that's actually wrong, that's 1%. So let's say it's $40 a year, then over 5 years, you would actually get $200 in interest. So you invested $2,000, 5 years later, you come out with $2,200. So if you get locked in at 2% right now for 5 years, but a year from now, that same bank is offering a 5-year CD for 3%, you lost out on that additional percent. So here's what I would do. I would basically put my money into 3 or 6 month CDs because you get your money back, you don't pay any penalty. Yes, you'll get a lower interest rate in the short term, but over the long term, you should get a higher interest rate if you keep doing this. So every 3 or 6 months, you basically you roll your money into a new CD, and that interest rate should be going up over time. So I asked this person, well, which bank do you bank with? And he said Mission Federal Credit Union, and this is here in San Diego. And so how would you do this? You would come here to checking and savings, and you'd come down to certificates. And then this is the example for this bank. And again, I'm not endorsing this bank or anything. I don't bank with them. I'm just going based on what the questioner banks. So see certificate terms and rates. So this is what you would click. And here you go, higher rates and flexibility. So check out our rates to see higher rates on some of our term certificates, including our 4 and 5 year term certificates with deposits of $10,000 or more. If you're looking for higher rates but also like the flexibility of a money market account, consider using your funds to open up several term certificates with different terms. You may have heard this referred to as laddering your certificates. So basically this is what I'm talking about. You take a little bit of money and you buy a 3-month, and then 3 months from now you buy or right now you buy a 3-month and a 6-month, and then 3 months from now you roll that 3 months into another 3 months, and and 6 months from now you roll that 6 months into another 6-month CD. Now they wanted you to commit more, obviously, because they benefit from this, but I'm telling you what you would benefit from. So if you click here on calculate dividends, you can go through this whole thing, but what I'm going to look at are dividend rates. So if you go back to here and you click on See Certificate Terms and Rates, you'll come to this screen. This is a PDF. And we're going to scroll down to Term Certificates, and then you have this chart here. So if you commit $2,000 to almost $10,000, and here are all your terms. So if you commit, let's say $2,000 for 3 months, you'll get a whole whopping 0.15%. It's not much. If you commit for 6 months, you get 0.25%, and then so on and so forth, down to if you commit for 5 years, you'll get 1.95%. Now, at the time he asked me this question last week, this was at 1.90%. So if he had committed last week for 5 years, he missed out on this additional 0.05%. Well, that's not a big deal, but over time, that's going to go up. I expect to see this 3% next year. So if you commit at 1.9% and it goes up to 3%, you've lost out over the next 4 years of an additional percent. This is why I don't think anyone should commit for the long term at this point. So just take a little bit of money, a little bit of interest rate. Now, if you have $10,000 to almost $100,000, you'll see how these rates go up, and it actually doesn't go up by much. So this would be my recommendation. Take a 3 month, take the pennies that you get from it, and then 3 months from now, this interest rate should go up. And then at that point, you can roll into another 3 months, and you just keep rolling over until you finally need the money. Now, you basically need to make sure you don't need this money for 3 months and stay safe with that. You will pay a penalty, so do not withdraw your money early. This is a commitment, and I would recommend this 3 month commitment. So I hope this helps you. And I hope to do a show. Actually, I went to this conference this past week. It was hosted by Tasty Trade, and it was cool. They basically run options software. They're an options software company, but they actually have a really cool website where they have 8 hours of programming a day teaching people how to trade options. Now, I'm a value investor guy, but I've been coming around to options lately, and I think it's a way to get into positions at a lower cost basis. And there's a way where you can reduce your risk and also have a high probability of success of getting into your equity at a lower rate. And so I want to do a show on that in the future. It might be this week, it might be next week, but I will tell you to stay tuned because that will be a great show. So have a great day. Thanks for watching, and we'll see you soon.